Good morning, everybody. It's always great to be back in Singapore. I used to live here. I love the place, and it's a very nice to get away from winter down where I live. It's getting increasingly cold, so it's always nice to spend some time in the sun. What I actually do is I am a sort of big picture analyst of the commodity space in Asia. What I tend to do is I try to get a bit ahead of where everybody else is in the market and spot the trends before they happen, and explain why I think things are moving the way that they do. Unlike your bank analysts or your consultancies, I'm not afraid to be controversial. It doesn't really matter to me what you think of me. It doesn't really matter to my company whether you disapprove, whether you dislike what I say. In fact, I love when people engage. I am prepared to be more opinionated than many, and I'm also prepared to be called out on it. There's no point in saying things if you're not prepared to argue your positions. So when I do presentations, what I try to do is set the scene, and I tend to do it with what we know. And I'm trying to just basically summarize what we see as the intelligence of the market as a whole, where I look at, what everybody's writing, what the vibe is, what do we know? So big, broad brushstroke stuff. Commodities have been an uptrend since 2016. We all can remember the losses from 2011 to 2016 when everybody was clinging on by their fingernails. So we've seen since 2016 March, things started to turn around. But if you actually look at it, and I've got a nice slide on this a bit later, it's not really been a very strong rally since that time. If you look at it in isolation, if you just did a graph from March 2016 to now, it actually looks like quite a good uptrend. But if you do it over a longer period, you'll see it's not so impressive. The other thing is, I always say China's still the main game in town. You have a country that is buying virtually more than half of all commodities that move around the world. It's going to be the important player no matter which way you look at it. So commodities are still very highly leveraged to China, and I don't see that situation changing. And then the other thing I sometimes talk about now when I do presentations is I've always been quite critical of the mining industry for not realizing how quickly public sentiment is changing vis-a-vis climate change and the greening of the world and how much of a threat the planet is under. I always say to people, it doesn't matter whether you believe in climate change or not yourself. That is an irrelevance. What matters is whether a critical mass of people in the world believe in it and are prepared to put up with a bit of pain as our governments legislate to deal with it. I think we've reached that point, that tipping point. I think particularly in the Western world, you're now getting a critical mass of people who are actually quite happy to take a little bit of an economic hit in order to save the planet, or believe they're saving the planet, depending on your perspective. Okay, the corollary to that is what we don't know. The US-China trade war is, for people like me, in some ways, a gift that keeps on giving. Every time you think there's progress, every time you think it's going to be solved, out come a few tweets from President Trump, and we're back to square one. My personal thinking on this is, if you actually look at how this has unfolded, everybody, as in the market wisdom, has generally been of the view that wiser heads will prevail, a deal will be done, it will all get resolved in some way or another. The reality is, we've seen escalation after escalation after escalation. So if you were being sensible, what you would really think is that we are going to see 25% tariffs on every Chinese export to the US and 25% tariffs on every US export to China. That's where we seem to be heading. I would love to be proved wrong on that, but the reality of where we started a year ago, where we are now, and where we might be heading points more to that outcome than we have a nice, resolved, peaceful, great trade deal. So I'll talk a bit about that as we continue. We don't really know how damaging this will actually be. One thing you can actually point to, and I'll show the data, is Chinese commodity imports have actually held up remarkably well throughout the year of the trade war so far. How long can that continue? How big a hit will happen? Can China actually keep on stimulating its economy? If I had $1 for every time people told me that Chinese credit growth, Chinese this was unsustainable, that it's all going to blow up sometime, I wouldn't be here, I'd be retired already. So the Chinese have a remarkable ability so far to keep their economy ticking along at a growth rate that they believe is necessary to sustain their economy and their country. Again, how quickly will climate change become a thing for the commodity markets? And really what the question you're really answering there is, how quickly do coal miners go out of business, and how rapidly do the people who are mining the stuff that is going to be used in the age of electricity, how rapidly do they get more money? How much more are they going to be building in the future? Okay, this is the graph that I actually talked about. The blue line is the Bloomberg Commodity Index, and the orange line is copper. And it's a fairly long-run chart. What I was basically trying to show there is, if you actually look, you've got the slight recovery from that first quarter in 2016. But overall, if you were actually trying to look at that as a trend, if you look at the Bloomberg Index, it's pretty flat. I mean, you're not looking at an impressive recovery. Certainly, it's not even as impressive as a recovery post the 2008 crash. So what you're really seeing is, if we are looking at where we are right now in the commodity space, we're looking at a very modest, not particularly impressive, almost flatline kind of recovery from what was a very low point in prices. So, I mean, the commodity index is nowhere near where it was even before the 2008 crash. So that's not a particularly optimistic or encouraging chart. And the longer you a technical analyst will tell you, the longer you have a sort of flatlining chart, you're going to need something major to either drive it one way or the other. And this is where your trade war concerns may move it, depending upon what happens. Another thing that I like to look at, because I think it's quite a strong correlation, is the Chinese PMI and copper again. Basically, within sort of a lag of a month or two, there's a quite strong correlation between those two indicators. So if you were looking for a recovery in commodities, the first thing I would look for is a recovery in the Chinese PMIs. We had seen a little bit of a recovery at the start of this year, and copper prices followed that. But then the Chinese PMI was quite unimpressive the last month. I think it actually slipped again a bit. If the trade war concerns continue, that particularly hits Chinese manufacturing. That's not a positive sign. So I would again keep an eye on that Chinese PMI. And believe me, the government in Beijing is doing exactly the same thing. What stimulus measures they will be taking will be targeted at lifting that particular indicator, or at least lifting the things that feed into that indicator. So again, that's not a particularly optimistic chart. One thing, I kind of talk a bit about Belt and Road. And I'm often asked, is Belt and Road more than just a marketing slogan? Is it a real thing? And what I actually have done with this chart is, if you believed Belt and Road was a big thing, what you would expect to see is Chinese outbound investment going up. And you would expect to see Chinese steel exports going up as they use their own steel to build infrastructure projects across Asia and into Africa. Except we haven't seen that at all. In fact, what we've seen is a dip. Now, what that line, the Chinese outbound investment line, doesn't tell you is that while their outbound investment has slipped, it has increased into countries that are part of the Belt and Road, the 64 countries identified as Belt and Road destinations. So it has gone up by about 8% in the last couple of years into Belt and Road countries. What it has done is slipped by about 25% into more developed countries, North America and Europe. But overall, what you're not seeing is a huge amount of money flowing out of China into infrastructure projects and other kind of projects around Asia and into Africa. And you're certainly not seeing a lot of steel leaving the country either. I know that there are steel tariffs imposed on Chinese or imports on China by many countries, but there's also a lot of countries that don't have domestic steel industries who love Chinese steel, who love cheap Chinese steel. And a lot of those are your so-called Belt and Road countries. So they would be the ones importing Chinese steel in order to build stuff, but you don't really see too much of that. So at the moment, I would say Belt and Road is a thing, but it's not really something that is making much of a difference to the way commodities are moving at the moment. I also like to look at iron ore. I know there's not too many opportunities for you guys in iron ore these days. What you're basically seeing there is fairly steady Chinese iron ore imports. China buys 2/3 of the world's seaborne iron ore, so it's important what it does. That run-up in price that you're seeing since January is all due to the supply outages at Vale and the cyclone in Western Australia. It's not a real reflection of, it's not a demand-driven price spike, it's a supply-driven price spike. Similarly, the dip in Chinese imports in April is as a result of them not being able to get the supply because of the outage in Brazil and the cyclone in WA. So, but what you're seeing overall is a fairly flat trend again. So you've got their iron ore imports actually went down slightly last year. In 2017, they were slightly up, but you're not seeing the strong growth of previous years. You're not seeing anything. You're seeing a meandering price, and you're not seeing a particularly dynamic market in many ways. That doesn't mean within the iron ore space there's not things happening. There's definitely been switches between the high grade and low grade, and there are interesting things going on. But the overall trend is still pretty much that China's a good, solid buyer, but it's not really driving the price in one direction or another. If the supply outages get resolved, particularly in Brazil, then you might find the prices start to moderate back to sort of within their recent trend line. That's kind of, again, it's not a negative on commodities, but it's not really screaming, gee, this is a market, let's go out and buy it. This is actually a chart I stole from one of my colleagues. It's not my own one. It's basically Chinese steel production versus the margin on rebar. What you are seeing there is quite a nice increase in Chinese steel output, but as they increase more and more, their margins tend to drop. That's basic supply and demand economics. But the Chinese steel mills have been very incentivized to produce at high rates because they've been making a lot of money out of it. They had a bit of a dip at the end of last year. Their margins have started to come back. I would expect that would mean that they'll be quite happy to keep buying iron ore and keep producing steel. Again, what we have seen with the iron ore market is that the Chinese are trying to use higher grade. The higher the margin on steel, the more they will prefer 62 and above and pellets. The lower the margin, the more that they will switch back to 58 and other types of less expensive iron ore. So within the iron ore space, if you follow the margins, you can probably work out where the demand is going to be in iron ore. I'm not really going to talk too much about aluminium. Again, it's the only thing I would highlight here is that there's a reasonable correlation between the Chinese PMI and the one I've got there is not the overall PMI, it's the manufacturing new orders index and aluminium prices. Again, I think a recent tick up, you might expect to see aluminium prices rise a little bit in London. They've certainly been lagging the Chinese ones. Again, I'm not terribly certain about that. Aluminium, it's not a metal I delve too deeply into, to be quite honest, because a lot of it is driven by what's available in the LME warehouses, and you have to really devote a lot of time to do that. And I'm too broad of an analyst to delve deep into aluminium. But again, what you're really seeing there is, it's not a chart. It supports my general overall narrative that commodities are doing okay, but not great. Coal is an interesting one. I know in Asia there's a lot of interest in coal. Particularly, it's one of the few things where you can actually go build a mine still if you're prepared to go to Indonesia and build your coal mine there. Global trade is flat. I mean, within a little bit of seasonality in that chart, tends to rise a little bit for the northern winter and then slip a bit in the shoulder seasons. But what you're really looking at is a flat overall seaborne world for coal, and pretty much flat prices. Yes, they've gone up a little bit, they've gone down a little bit, but you're generally not seeing a hugely volatile, dramatic market. I think that's probably hiding the fact that coal has basically left the Atlantic basin and has come to Asia. So where the world's coal is going is basically now almost entirely an Asian story. On the longer term, I would look at things and say, who are your world's biggest importers? China, India, Japan. What are the policies of each of those countries? India wants zero imports. That's unrealistic, but that's what they say they want. Japan is increasingly moving away from coal. Virtually every month you get stories of how they're not going to build the planned coal-fired power plants that they said they were going to do. China has a policy of reducing coal as a part of its energy share. So I would say the future for thermal coal is particularly troublesome. I think if you're looking at coking coal, yes, that's the one place. If I've ever asked what mine would I like to own, I'd like to own a low-cost coking coal mine near a port. It doesn't really matter which country, because I think the last block or lump of coal burnt in the world will probably be a piece of coking coal. So that is the one market where you've got still a viable longer-term outlook. Coal's not going to disappear quickly. A lot of the coal-fired power stations that have been built are very new. They're going to run for a while. But it's going to be increasingly difficult to justify building new power plants and new mines to feed them. What this actually means is, ironically, the coal seaborne market will become increasingly tight and prices are likely to rise. But high prices are actually a bad thing for the coal industry, because it will reduce their competitiveness against cheaper LNG. So there are still opportunities in coal, but they are starting to slip. And coal has been rightly or wrongly cast as the global bogeyman. And I think once you've lost that sort of social license, for want of a better word, it's very hard to get it back. Witness the struggles of Adani to get their Carmichael mine off the ground in Australia. I am quite honestly will admit that the adding of 8 million tons of new coal being burnt is not going to really change the climate balance much at all. But the public in Australia believes that if that Adani mine goes ahead, the Great Barrier Reef is stuffed. So I think it's going to be very, very hard for Adani to get that mine up and running. I have a long-standing bet with an Adani executive who shall remain nameless, that if they do get it up and running, I will write something very nice about this plucky Indian company that took on everybody in one, which was fine because it would be true. And if they don't get it up, then he owes me a case of wine. I'm still selecting the wine at this point. Just quickly look at China. What I've done here is, rather than use the Newcastle price as the orange line, I've used the Argus Indonesia low rank coal price, because that's China's the biggest buyer of that type of coal. And it's quite interesting that you can see that the price of Indonesian coal is quite well correlated with Chinese imports. I think this is a trade that I expect to actually continue for some time. The Chinese have very solid reasons to buy low-rank coal from Indonesia. It's also maybe low in energy, but it's also low in sulfur. They mainly use it for blending. So you've got a nice trade from Indonesia into southern China. It's blended with domestic coal. That way they can meet their environmental obligations when they burn it. So there's a nice solid bit of that trade that's likely to continue. The thermal coal at risk in China is actually mainly Australian. The Chinese can do without it. You saw that they did crack down on Australian coal imports in February. That was, I don't really know why. I would tend to believe that there was a little bit of an element of a political message being sent to Australia. Don't get too close to Trump. Remember who gives you all your money. But what you saw very quickly is that China started clearing the cargoes again. China can't do without Australian coking coal, especially since they're not buying any from America. So who are you going to buy it from? You've got very few options. You can buy it from Australia, you can buy it from Canada. Even if you bought every lump of or every piece of coking coal out of Canada, you'd still not have enough. So the Chinese have no option but to buy Australian coking coal, but they have options on thermal coal, and they may well exercise those in the future. China has a policy they don't want to import more coal than they have been doing so in recent years. That's still quite a lot, 250 million tons, say. But you're not looking at a growing market. In fact, it's very hard to find a growing market in coal in the seaborne world, especially since a lot of countries that were expected to keep on building new coal-fired power plants are pulling back from them. Malaysia, Thailand, Vietnam, all these places that were going to be the next big hope for coal are now reconsidering them. Mainly because the climate activists have been very effective at getting banks and people to stop funding them. I mean, I've been giving them this, maybe I shouldn't have, but I've been giving them this advice for the last, I don't know, almost decade, is if you want to stop something, go after the money. Don't chain yourself to a coal loader at Newcastle Port. Yes, that gets you on the front page of the papers and a bit of TV that night. It doesn't stop anything. What you want to do is you want to go after the people who give money to coal miners. And if you can convince those people not to do that, and you can convince the insurers not to insure the mines, well, then it's very hard to build one. It's very hard to operate one. So the green activists are getting much more sophisticated in how they are going after things. And it's kind of interesting if you look at it. They haven't attacked coking coal. They've really only attacked thermal coal and now natural gas. And they've always had a bit of a problem with oil, and they've always had a problem with nuclear. But if you actually look at where they're putting their efforts, the thermal coal miners are completely attacked by them. The coking coal miners get a free pass. Very interesting. I'm not a gold analyst. I do love gold analysts, because I've never met a gold analyst who is not a bull. It seems that if you want to be a gold analyst, you have to be a bull. I've never met one who said to me the gold price is going to fall. Never, ever. Even when the gold price was plummeting. It's just an aberration, it's coming back, we're all heading to $10,000 an ounce. And I always find that quite an interesting thought, actually. I mean, I knew gold was going to fall because in about 2012, I was actually contemplating buying it. So if I was going to buy it, then you knew the rally was finished. And I think that's, it's not, I won't call it the Clyde index, but when small retail investors such as myself start to see something as a good buy, that's normally the time to get out of it. When I look at gold, my own view is that basically, for gold to have a sustained rally, you need three things to happen. What drove it to its record high in 2012 or whenever it was a combination of strong physical demand out of India and China, which account for more than 50% of physical gold, strong demand from central banks, mainly developing market central banks, and strong Western fear trade expressed through the buying of ETFs like the SPDR. So you had three things working all at once in one time, and that drove gold to a record. Then one of those legs was knocked out, and that leg was really the Western fear trade. SPDR holdings went down. You still had relatively good central bank buying, you still had relatively good Chinese and Indian demand. Then Chinese demand, another leg got knocked out, and that's why you see gold went down all the way. I know a lot of gold analysts basically only see gold as an expression of US monetary policy. My personal view is that model went out the window in 2008, and you need a new model. But like I say, I'm not a gold analyst, but I can look at the charts and I can see what's happening. So right now, I think the gold bull case is struggling a bit. What I'd like to see is more buying of ETF holdings. You've got nice central bank buying still. You've got actually quite good buying out of China and India. So you've got two of the three legs. You need the third leg. And our friend President Trump may well provide you that third leg. But it's not necessarily there yet. So gold is, I think it's getting close to one of those inflection points. And I can't tell you which way it's going to break. You're going to have to watch what actually happens to see what is actually changing. So, from my mind, watch the three things that I've mentioned, see how gold goes, and yes, look at the Fed and its moves in monetary policy, because a lot of the gold market still believes that that's the thing that is the sole driver of it. And if you start to see those things changing, then gold's bull case will come back. I know this isn't an oil conference in any way, but if you do want to find a positive commodity story in the world, crude oil is it. China's imports are rising quite strongly. They're up 8% so far this year. That's mainly reflecting the fact that they've built a lot of refineries and they're now processing the oil through that refineries. Yes, they're exporting a lot of products as well. That is the effect of depressing product margins in Asia. It doesn't really affect their crude demand. The price hike in oil is largely a reflection of OPEC limiting supply and the US putting sanctions on Iran and Venezuela. Within crude oil, there's very interesting dynamics happening. The barrels that are leaving the market tend to be heavy sour crudes. The barrels that are arriving in the market tend to be light and sweet. What you're having then is you're having a shortage of middle distillates like diesel and jet fuel, and a surplus of light distillates like gasoline and naphtha. These are, it always used to be where I live in Australia that petrol was more expensive than diesel. Now it's the other way around. Diesel's about 10, 12 cents a litre more expensive than petrol. That's a reflection that refiners are unable to secure or have to pay more to secure heavy crudes, particularly in Asia, because they all built all their refineries to process heavy Middle Eastern crudes or Venezuelan crudes, and now they're not getting them. What they can buy easily is light crudes from the Gulf of Mexico, or the shale oil, and that kind of stuff. It's no coincidence that the most expensive oil in the world is now a heavy sweet crude produced off the coast of Western Australia. Trades at an enormous premium to everything else because it yields a huge amount of middle distillates when you process it. So it's now very sought after. Unfortunately, they only make about 20,000 barrels a day. So, but that's the kind of dynamics within the crude market. I think if the US is successful in crimping Iran's exports, probably not down to zero, but let's say to under 1 million barrels a day, you are tightening the oil market. Donald Trump is really relying on the Saudis to play ball and up their production. The Saudis, they'd be kind of happy with at least $80 a barrel oil. Trump would only be happy with 60. Somewhere in between there's going to be unhappiness. So unfortunately, oil, I think, is heading to be a more geopolitically driven commodity at the moment than just a straight underlying supply and demand. What I can tell you in the physical market is that the premiums are rising. So you have official selling prices throughout, the Middle East, and then if you actually want to buy oil, you have to pay a premium or sometimes a discount to get it from that official selling price. And right now, the premiums are going up. That's a sign of a tight market. So I'd expect oil prices to keep going up. Let's see what else. LNG, I just won't talk about too much. The LNG market is one where you've had a lot of supply come on. That's driven the price lower. The red line is the sort of market consensus forecast of where LNG will be, the amount needed by 2030, and 700 million tons a year is actually on the more cautious side of the range of estimates. There are people talking 1 billion tons. What I actually see there is that's a huge jump from where we are now. LNG plants take a long time to build. I'm not sure we'll get there. I also think LNG as a next bogeyman in the climate activists' targets might struggle a bit. I think, unlike coal, they still got an opportunity to switch. And if they can switch themselves into powering every ship on the earth and doing a whole lot of range of other things with their LNG, then they've still got a very positive story. But they need to start doing that now. If they're thinking that they're going to be a fuel for electricity generation, I think they're kidding themselves. But whether they can pivot successfully remains to be seen. That just kind of tells you that, you've got tremendous growth in Chinese LNG. They're now the second biggest importer in the world, but it's not a guaranteed. Yes, there's always seasonality. You get a peak over winter and then it falls down. But, the peaks, this last winter peak was very high, but the fall off has been quite dramatic. And that's, you've seen the effect on the spot price, so you're getting lower demand growth and you're getting higher supply entering the market. Prices are going to fall. But if you were looking for China to be the sort of engine of LNG growth in future years, that might not be as set in stone as people believe. Now we'll talk about the elephant in the room, US-China trade. This is just basically a graph that shows you how the trade is moving. These are dollar value figures. You see the dip that came with the first round of tariffs. Logically, you would expect this second round of tariffs will lead to a similar kind of dip. And the point I try to always make on this is when you enter into a tariff war, the country that has a tariff imposed upon them, China in this case, tends to feel the pain much quicker. There's an obvious and immediate hit to them. Their products are no longer competitive. They either have to absorb margin or accept lower market share. That's quite an obvious hit. The country imposing the tariffs gets away with a free ride for a year, maybe even 18 months. But then it starts to hit them because the costs of the goods that they're selling start to rise. It's very hard to re-engineer supply chains as quickly as that. So what the tariffs are doing into America is they will introduce inflation, especially as they increase them to 25% and target more and more goods. As I said, eventually I expect every Chinese export to the US will be at 25%, and every US export to China will be at 25%. I'd love to be proven wrong, but let's just assume that happens. Who hurts the most in that scenario? Well, actually, it probably ends up being the Americans because it's a bigger hit into their consumer spending. It's a bigger hit to their inflation. What does Trump not want? He doesn't want a low equity market, and he doesn't want higher interest rates. What are tariffs actually going to do? They're going to cause interest rates to rise as inflation enters the system, and that's going to hit equities as consumer spending slows. So he's taking a bet, I guess, if there is a strategy, he's taking a bet that he can get a good deal, have a victory, say how great he is before it gets out of hand. But so far the pattern is things get out of hand and he doesn't really know what to do about it. I love this little graph. I won't talk too much about it. What does Make America Great mean to Trump voters? This was done from a Reuters survey. The important thing here is, for most of them, it means a better economy. So if Trump is really trying to get reelected, and we have to believe that he's doing so, because not to be reelected probably means he will be arrested, he has to deliver a better economy. That is his key issue. Stronger borders, yes, that's something else, but the key issue is a better economy. So everything that you're going to see him do, especially as we get into closer and closer to next year's election, is going to be aimed at boosting the equity market, boosting jobs, that kind of thing. That's going to be his focus. It has to be, because that's what his base wants. My final thoughts. I believe that Trump is the elephant in the commodity room. I believe that very few people actually talk openly about him. I don't actually, for me, it's not important whether you believe he's an appropriate person to be US president. It's not important whether you moralize about his alleged relationships with porn stars or things like that. He is a US president and he has effects, or he has an impact. I think it's time to actually start looking at what he is actually doing. So far in the commodity space, he hasn't really actually been a disaster. China's managed to keep its economy going, commodity imports have held up, prices have held up, but we haven't had a rally that you might have expected if the world economy was as strong as Trump says it is. You would be expecting a stronger recovery in commodity prices. You would be expecting an acceleration of the global economic cycle. I think what the effect of Trump is that he hasn't crashed the world economy, he's just kind of slowing it down and putting question marks, and people are worrying about it. I think China is still obviously the key, but the risks are mounting there. You've got to work out whether the Chinese can successfully keep stimulating their economy. I think that's probably possible. I really do believe that commodities are going to become split between the green and the dirty. The dirty is currently coal, but you've got to add into that list LNG and possibly a few other energy kind of products. And the clean, well, the obvious ones are the battery metals and the components of that. I think copper miners have a very good chance of getting themselves in the clean group. Iron ore might struggle a bit more, but if they can say steelers are needed for all these things, then they can get there too. But I think you're going to have a split in the mining industry. I think also the mining industry has to realize that things are going to change. I think they're going to have to look more at how they offset the emissions they create by mining, and perhaps even further down the chain, how they offset the emissions created by the use of their products. They won't want to do this, but you should do that. I think the risks are certainly rising for a lot of, how you get projects up and running and how you get things off the ground. It's getting harder and harder to find the ones that are surefire bets. And you've now got to look at your industry image and how things are going there. Once again, you always, I mean, it's kind of stating the obvious. The early movers do get the advantage. Latecomers can still work, but they've got to have the lowest costs in the game. And I think I will leave it at that. And if anybody has any questions for me, I'm going to be on the next panel, and so you can feel free to fire away then. Thank you.
Thank you very much, Clyde.